I'm here with Lauren Ryan, Business Development Manager Investments at Thinktank. Lauren, welcome to the Inside Network's Income and Defensive Assets Symposium.
Thanks, Tahn. Thanks for having me.
Now, for advisors new to Thinktank, could you give a quick summary of what you do and the solutions you offer?
Absolutely. Thinktank's a non-bank property lender. We offer loans to borrowers who are self-employed or SMEs or looking to purchase through an SMSF or a company or a trust, or a borrower who is looking to grow their investment portfolio and they've capped out at the banks. So we offer those lending solutions for people that just don't quite fit into the bank's models or who run their lending through an entity. On the investment side, we issue commercial mortgage-backed and residential mortgage-backed bonds. So we offer bonds to investors that they can invest in, receive the monthly income from the underlying mortgages, and the capital is secured by the property that we take the first mortgage over.
Now, investing always involves some level of risk. How do you think about capital protection in the mortgage market?
The way that we look at capital protection is around the loan-to-value ratio or the loan size. So Thinktank offers, generally our loans are relatively small. They're sort of around the $650 on average, $650,000, $700,000 mark. And our average LVR across the portfolio is 66%. If we see that a borrower's quality and their loan servicing ability can increase that LVR because of the quality of the borrower or the business or the asset, we can increase that LVR to sort of your 75 to 80%. If a borrower is looking to use a security property that's a little bit more specialised, then we can reduce that LVR or we can reduce the loan amount. So we've got a few different levers there to protect investors by making sure that what we offer the borrower is a risk-adjusted loan based on that capital protection as sort of our primary focus. On the investing side, we issue a bond, which is a debt instrument, and many of your viewers will know that if you don't meet those repayments on a debt instrument, then essentially the investors can come and vote on what to do with the product. So we are very much incentivized to meet our monthly coupons and meet our repayments to our investors, both income and capital. And in our transaction, Thinktank owns the junior equity or the first loss piece. So there are quite a few levers in which we can pull to make sure that our investors are protected.
Now, many advisors are looking for what you might characterise as resilient income for their retiree clients. What can private credit offer here?
With what we do at Thinktank, our returns are linked to the bank bill swap rate 30 days over a fixed margin. So in terms of resilient income, you're only going to see any variability when it comes to the cash rate being increased or decreased. And it's all a risk-adjusted return. So our borrowers are majority on variable loans. So if the cash rate goes up, which it has over the last few years, our investors' returns are going up. If the cash rate goes down, then the investor's return will go down, but also so will what the borrowers are paying, and so will the risk. So the way that we structured our product is very much to provide investors with a fixed component to that return, so that reliability of their return, plus the bank bill swap rate 30 days, that's the only variable component. So investors don't have to worry too much about there being large swings in their return based on the performance of the underlying loan, because their return is linked to a fixed rate plus a benchmark.
And how do you go about building diversification across the portfolio?
As a small ticket lender, it's our prerogative to write lots and lots and lots of small loans. So our loan book's about $5.9 billion. Thinktank works with aggregators and brokers to distribute and find quality borrowers all across the country and across lots of different asset classes, lots of different businesses, lots of different areas. So you're very well diversified across the country. And we work with our senior institutional funders to offer new products and expand our commercial and residential offerings.
And what makes this strategy of particular relevance to advisors as we close out 2024, at least coming to the back end of it?
For advisors looking for relatively stable income secured by a diversified pool of mortgages, this is Thinktank's bread and butter. The illiquidity side of what we do isn't for everybody. The lack of volatility in returns might attract people to this asset class if they're comfortable giving up a little bit of illiquidity. For advisors who've got clients who are looking towards retirement and are looking for regular, stable income, that's a solution that we absolutely solve for. And because our underlying security properties are small ticket domestic residential and commercial property, there is a level of security that sits underneath the whole portfolio, which many investors in Australia are quite comfortable with property, both small ticket, commercial and residential there. So our offerings solve for a variety of different solutions that advisors are looking for. If you're an advisor looking for capital growth, that's probably not where we fit in. We fit into the relatively boring, stable, reliable income side of their portfolios.
Wonderful. Thanks for joining us, Lauren Ryan.
Thanks so much.